Central banking is worse than you think. Most people believe that banks are intermediaries that collect deposits and then loan out those deposits to other people and collect interest. And they call this the intermediation theory of banking. The more savvy have heard of this thing called fractional reserve theory of banking, where the banks can lend out up to 10 times or even more of what they have in reserves, and that the Federal Reserve is the thing that makes the whole system solvent. And you may have noticed so far that we've talked about theories of banking, which should strike you as kind of odd when we're talking about the foundational thing that makes our entire economic and monetary system work, the banking system. But what if I told you that the only empirically tested theory of banking that has ever been carried out proved that a whopping 97% of our monetary supply springs into existence out of nothing by individual banks when they make loans? Economist and Professor Richard Werner is the only person in the 5,000-year history of banking to actually test what happens on the bank's ledgers to see exactly where money comes from when a bank issues a loan. His paper, Can Banks Individually Create Money Out of Nothing?, published in the International Review of Financial Analysis in 2014, detailed his experience of working with a German bank behind the counter examining the ledgers from beginning to end when he received a €200,000 loan. Shockingly, he discovered that the bank did not move funds from one account over to his account, nor did they petition the German central bank, but they recorded the loan as an outgoing loan and a deposit at the exact same time. And if you're breathing a sigh of relief because this happened in some far-flung German bank and you're an American, take another breath, because all modern central banks operate this exact same way.